Hi everyone, this is Accounting Made Simple with Akim. Today I'll be talking about IFRS 3 business combination. IFRS 3 business combination is a standard that complements IFRS 10 consolidated financial statement. I would strongly suggest for those listening to this IFRS 3 to look out for my video that I did previously on IFRS 10 consolidated financial statement. Because this standard does not teach us how to prepare consolidated financial statement, but only provide a guidance on what is needed in terms of disclosure and also in terms of measurement of fair value of the net assets that we acquire in business combination, as well as non-controlling interest and goodwill. Um, So the objective of this standard solely to improve the quality of information that uh, the um, the acquirer, let me say the reporting entity, is providing when it preparing the financial statement after combination or after consolidation of the subsidiary into its operation. So the first thing we need to look at is the guiding principles for business combination, which ensures that financial statement reflects the acquisition and its impact accurately and transparently, so that the users of financial statement will be able to understand uh, the quality of information in terms of the fair value of each of the asset that was acquired on business combination, and also um, this standard also outlines the process involved in the recognition and measurement of these identifiable assets that we are talking about, and also liabilities, as well as non-controlling interests. The standard also helps us to measure, to look at how to measure goodwill. Let me say that how to measure goodwill, including all relevant disclosure requirements from time to time. Um, So there are certain steps we need to look at under IFRS 3 business combination, because the standard says that we should use acquisition method when we see that a business combination has occurred. Sorry, business combination has occurred in the process of acquiring the acquisition between the holding company and that of the subsidiaries. So, and these steps include: we identify the acquirer, which is the first step of business combination. So, how do we identify the acquirer? It means the entity that controls the other entity. But I would touch more on that as this presentation goes on. The next step is to determine the acquisition date. So this acquisition date can be a bit tricky, because acquisition date could be a date before even signing of the agreement, or a date even after the signing of the agreement, or some legal date, maybe regulatory approval date or something. So depends on actual time when the control actually occur, which is the physical control. So we'll also talk about that later on. The next one is to recognize and measure identifiable assets, liabilities, and non-controlling interest. So we need to measure these assets and liabilities at fair value, and non-controlling interest also at fair value. Then the last step is to recognize and measure goodwill or gain from bargain purchase. So goodwill can occur on business combination, or a gain on bargain purchase can occur, which is the reverse of the goodwill. So, but before we move further, we need to look at how, because when you say you have a business combination, you need to test whether it's actually a business combination. In some instances, um, some acquisition will not amount to business combination. So we need to look at certain tests to be able to understand, or to be able to ascertain and assess whether this acquisition is actually business combination or just acquisition of an asset. So the first step the standard prescribed is looking at what we call input, process, and output test. Input, process, and output involve. Let's look at a typical organization. When you acquire an organization, it means that organization has a series of inputs like assets, like let's say PPE, for instance, property, plant, and equipment, inventories, and others, and also those inventory or the asset or whatever the business does is being processed by way of a certain production process in the system, or if it's not a manufacturing entity, they say a service organization having some activities in it, or in the form of employee activities and other things. So those are the process involved in typical business. And the last but not the least is the output, which is the result the business is producing in terms of the profits from the business, or sales from the business, or activity leading to maybe a return on investment. You understand? So those things shows that you have actually acquired a business. So that is what the standard prescribed, that we should look at this test to know whether what we have acquired will qualify as a business combination or not, or just like maybe acquisition of ordinary assets. Another test that the standard prescribed, which is something that came after some time, a vary of the standard, is a concentration test. That concentration test is largely optional. We are not required at all times to do it, except when required. So, so this one looks at um, the assets that was acquired on business combination. Let's say we identify all the asset value. I mean the gross asset value, and the next thing is to evaluate whether there's any concentration. I mean in terms of the assets that were acquired. So we assess if substantially the fair value. That's what we said here. If substantially the fair value of all the assets acquired is concentrated in a single asset or a group of similar assets. So what we are saying here is that um, we acquire, say, property, plant, and equipment, say from an organization, and those property, plant, and equipment. When you look at the fair value of this acquired asset, is it a single set of assets? Like, okay, like let me use an example of uh, a typical gas plant. A typical gas plant will have what we call compressors, other assets. So when you go to that plant and acquire, let's say, the list of some assets, and those assets are concentrated, like, and they are similar. So in that case, we may not actually see it as a business combination because it's only an asset. Because the organization will have much more asset, like maybe motor vehicle or land and building or other asset. But if it's a typical class of asset, let's say a much more concentrated asset or some similar asset acquired, we do not see that as business combination, but just acquisition of ordinary asset, which we expect to be treated under IAS 16, which is different from business combination. And the last part of the test is to look at comparing the fair value of the gross asset acquired with the fair value of the identifiable assets or group of similar assets. Say, for instance, when we cited the example of a typical gas plant, and when you look at the gross value of the asset acquired, I mean, uh, you compare that value and you're able to see that, say about say 85% or 90% of these gross assets, it takes more than 90% of the fair value of the asset that you can see at the point of acquisition. That is purely um, uh, asset acquisition and not a business combination, because in that sense, we say uh, the the acquisition passes a concentration test. So let's look at a scenario here. Looking at company A, which acquires land and a building. If the land and building together account for 90% of the total fair value of the acquired assets, when you say you acquire some asset and you look at the land and building, it account for 90% of the value of the acquired asset. This acquisition passes the concentration test, indicating it is not a business combination but rather an asset acquisition. So looking at this test, though it's optional, but it's a guide for us to be able to understand whether we have actually done a business combination or just asset acquisition, which should be accounted for or measured under different standard, which is IS 16 and other standard like IS 2 others. The next thing we need to look at is to look at the steps of the acquisition method that we mentioned earlier on, which is the first thing of identifying the acquirer. What do we need to do to identify the acquirer? We have it might not necessarily be the 5 steps I listed here. It might be maybe 3 or 4 of them, but we need to consider what we call the voting rights. What is the voting right? Voting right is the power is a power that an investor has to control the board. I mean, a certain voting decisions in the board, more than, let's say, more than 50% of the board. And in terms of making some strong decisions in the board, in terms of voting power, that entity has more than 51%. It means that that entity has a voting right in the investee or the subsidiary. Then another thing that I talked about is power to appoint or remove any of the board members. If you have that power to appoint member of the board, uh, reappoint another member, or remove somebody from the board, it means the entity is the acquirer in that instance. Another thing to look at is control over decision making. If somebody controls 51% and there's a maybe a certain decision needs to be made, maybe in terms of research and development decision, it means at every point in time that entity will control the decision making process in the in the meetings of the board. So looking at those three steps, if you look at the voting right, power to appoint or remove any member of the board, or control over decision making, are all revolving around control. I mean control in terms of the power, the you under IFRS 10 we say we have the power to vary the returns in the investee. That power enables you to vary the returns, to affect the returns or exposure, because that entity is expected to have it will be having exposed or have power to some variable returns in the investee. So looking at these three things, we are saying that that power will make the investor to variable those returns or variable decision making process in the investee. So that is what we're saying. Sometimes we also look at the size of the entities, maybe a larger entity and a smaller entity, but this is not always the case in most of the. We have seen situations where a smaller entity acquired a bigger one, so that could not, but that could also be a condition to consider. And also, there could be some terms in the combination agreement that says, okay, this party controls this, or like maybe issue of shares to some um, shareholders of the subsidiary. So in that case, we show that there's a control, or there's power to control the affairs of the subsidiary. So let's look at the scenario here. That scenario says company A, a large technology company, and company B, a smaller but rapidly growing software company. decide to combine their businesses. Under the agreement, company A will issue shares to the shareholders of company B. So look at this place very well before we move on. Company A will issue new shares to the shareholders of company B. And when I was talking about it, I made mention of under these terms of the agreement, maybe issue of shares to the shareholders of the subsidiary. So from there we could see something, but I don't want to say what it is now at the moment. After the combination, company A shareholders will own 60% of the combined entity. It's still tilting towards company A here. Own 60% of the combined entity, and company B shareholder will own 40%. The board of directors of the combined entity will be composed of 7 members, and 4 of whom will be from company A. So this is another pointer towards that company A is the acquirer, and 3 from company B. Then company A CEO will become the CEO of the combined entity. So let's now look at those steps that we mentioned and see how we can use those steps to see who the acquirer is. So the first thing is the voting power. We said company A shareholder will hold 60% of the voting right in the combined entity. When I was making my simple example earlier on, I said something about 51%, making it having a voting power. So in this case, 60% interest in an entity automatically give you the power to of voting. I mean the voting right. So it means that company A is the acquirer. Looking at that from that instance, let's look at another angle to it. Control over decision making. Who controls the decision making process in the board? We have 7 members in the board, and we could see that company A has 4 members out of 7 members. So they have the majority in the in the board. So it means in that decision making process, company A will also control the board. Let's look at another scenario again. Terms of the combination agreement, I mentioned of it that company A issued its shares as consideration for the business combination. You understand? So company A now issues shares to the shareholders of company B. So who pays the consideration here? It's company A, because company A pays by issuing shares. So you can the consideration for acquisition could be issue of shares or other things or interest. So that one signifies that company A is the one paying the consideration, and whoever pays the consideration is the acquirer in a business combination. So the next one is to look at the leadership structure. In terms of leadership, company A CEO will become the CEO of the combined entity after the business combination. So all these 4 pointers shows that company A is the acquirer. So we could have much more difficult situation to work with, but looking at this, I think however difficult it is, if you follow these steps that I highlighted for you, these steps, considering the voting rights, power to appoint or remove any member of the board, control over decision making, and terms of combination agreement, you will be able to know who the acquirer is. So let's now look at the next step, which is determining the acquisition date. So this can also be tricky, like the determining the acquirer. So I'm also looking at 3 major criteria here for me to determine the acquisition date. We look at the control date. Control date is the date that the investor takes control over the affairs of the investee, or the holding company takes control over the affairs of the subsidiary. Legal and regulatory consideration could be in terms of maybe filing requirement for maybe shares issued or anything, or signing of the agreement, or solicitors agreement or something like that, and filing of this legal consideration or regulatory consideration could also help us determine what the acquisition date is. And also practical control, I would say, if I want to rate it in order, I would say practical control take more precedence over control dates and also legal or regulatory consultation, because this date can vary. But when the entity is able to control the affairs of the board and making informed decisions in the board, varying the returns or varying the activities of the subsidiary, then we can say that there's a practical control. So yeah, let's look at another scenario to explain what we mean by those three criteria I mentioned. Looking at company X here, a large manufacturing company agrees to acquire company Y, a smaller competitor, to expand its market share. The acquisition agreement includes the following key dates and conditions. So the first one is signing dates of the agreement. I mean, we are signing the agreement that we are acquiring company Y on 1st of January 2024. Then that signing or the agreement goes to the board. I mean, goes to the shareholder for approval, and the shareholder says, "Oh, we are approving it on 20th of January." After, that 20th of January is a date after the signing, which is 2024. Another date is regulatory approval, maybe seeking approval from the government or maybe Security and Exchange Commission, depending on the jurisdiction of the entities on acquisition. So it says February 15, 2024. This is a regulatory approval. And legal closing date, which is closing the legal agreement and also all regulatory approvals, is February 28, 2024. So let's now look at this and tell us, using these three criteria to determine what the acquisition date is. So the first thing is legal and regulatory requirements. Let's look at legal and regulatory requirements in this question. The acquisition cannot be considered complete until all legal and regulatory requirements are met. In this case, regulatory approval is obtained on February 15, 2024. Can we say that date is the date of acquisition? Don't let us conclude yet. Transfer of control. We say that the acquisition agreement specified that the legal closing date is February 28, 2024. It's different from regulatory approval date of February 15. We have another date here, legal closing date, which is February 28, 2024. Is when company X will take possession of company Y's assets and operation. In that instance, looking at these two, which one do you think takes precedence? I said it earlier on that control take precedence on anything. Control can occur at any point in time. So let's now conclude. The practical control now, even though the signing date is January 1, 2024 and the shareholder approval date obtained on January 20, 2024, company X does not gain control over company Y until the regulatory approval on February 15, 2024. However, can you see this February 15, 2024 took precedence over the signing date and also the shareholder approval date, because it's a regulatory approval date. But something also we need to look at is practical control, including decision making and power and management influence, is not transferred until legal closing date on February 28, 2024. So the legal closing date is now the acquisition date. If this legal closing date is not there, we will say February 15, 2024, which is a regulatory date, will take precedence over the shareholder approval date and the signing date. If that is not there, we also look at the shareholder approval date. So those are the ways to look at the acquisition date. So however the question may come from, using these three criteria, you will be able to determine the acquisition date. So the next thing now is to look at how do we now say we recognize and measure identifiable assets, liabilities, and non-controlling interest. The standard says that an asset is identifiable if it is separable, that is capable of being separated or divided from the entity and sold differently. You understand? We can say that this asset are identifiable. You can know that, okay, for an entity, you can see the property, plant, and equipment. You can see inventory. You can see maybe cash. You can see receivables. You can see all assets of the entities. You can see them separately. So these assets are identifiable, but if they are lumped together, you are not able to identify. So they are not identifiable assets. So you need to be able to identify them, because at some point in time you need to do fair valuation. Okay, like for instance, property, plant, and equipment, you need to do fair valuation of it, and the excess is also considered in business combination under consideration of financial statement, IFRS 10. So we need to be able to identify those assets, and those assets and liabilities should be recognized at their fair values. So at their fair value, this means that the cost relating to the asset and liability need to be recognized will not include the cost the acquirer expect to incur. So when you look at some expectation of some costs in the future, that okay, you are expected to incur this cost, but you are not under obligation because you are not bound by any law or any legal agreement, then you will not need to add this cost, because you are not bound by any agreement. It's not actually a contingent consideration or contingent liability to be which you are under obligation to do. Another thing that we also need to look at is if there are assets and liabilities that are exchanged on a separate transaction other than that of the business combination, like outside that business combination, those assets and liabilities will not be added as part of the identifiable asset at fair value. So there are certain exceptions to this rule. We have exceptions on contingent liabilities, employee benefit, for instance, which negates what I said earlier on, that you have obligation, you have expectation but not obligation. But in cases of employee benefits, which is under, I think, IS 19. So if you want to look at this critically, go and watch my video on IS 19 employee benefits, so that you can understand that in detail. Income taxes, asset held for sale, IFRS 5. So all those things are exceptions to the rule. Also, we need to now look at non-controlling interest if, after we have been able to identify, recognize and measure identifiable assets and liabilities of the entity. So we use two different methods, but before we look at the method, what is non-controlling interest? Non-controlling interest is equity interest in a subsidiary that is not maybe directly or indirectly controlled by the parent company or the investor. So for instance, you have you bought 80% equity interest or 80% shares or investment in a subsidiary. There's still 20% that is left. So that 20% is a non-controlling interest. So, but for us to be able to determine this non-controlling interest, we use two different methods. You see that we look at the fair value of the net asset of the subsidiary as a whole, and now take percentage of it. So, like for instance, I made mention of the agreement says 80%, 20%. So 20%, we can take 20% of the fair value of the net assets, that is the identifiable asset and liabilities, net of them. The 20% of it, then we can say is a proportionate share of the net asset, and that will be the non-controlling interest, which is the first method. The second method is to look at what is the fair market value. I mean, a market value of the interest held by the non-controlling interest. So at that point in time, when you look at the valuation of the business, what is the value of the shares of that business? You understand? So when you now look at the non-controlling interest, you can use that fair valuation approach also to look at the market value. At that point in time, you can determine that is a full a full approach by looking at the entity as a whole and taking the non-controlling interest, the fair value of the non-controlling interest at that point in time. So, but if you want to have in-depth understanding of how non-controlling interest is being calculated, I think we need to go and watch my video on IFRS 10 consolidated financial statements. So, and the last but not the least of the processes to business combination is to recognize and measure goodwill or gain on bargain purchase. So, what is a goodwill? Goodwill is an asset. Goodwill is an asset on its own. So let's bear it in mind. Goodwill is an asset. That is, this is the asset for the future economic benefits. That is asset accounting. That's what I use here. I said this is asset accounting for the future economic benefits. There's a future economic benefit when you acquire an entity. It's like you are acquiring a property, plant, and equipment. It is expected that that property, plant, and equipment will bring future economic benefit to the organization. That's why you acquired it. By way of selling it, number one, you can make economic benefit from it, or by way of using it for production process. But when you say you acquire a business, there's an asset that would come as a result of the acquisition of other assets. So you are expected that, okay, when you acquire this other asset like property, plant, and equipment, PPE, inventory, receivables, and others, when you acquire these assets and liability, there is a future economic benefit that will flow to that entity because you acquire it. So that asset is called the goodwill. So the goodwill occur when the fair value of the consideration that you pay, because when you are acquiring an entity, you pay consideration, and the consideration can be in different ways. So I will define that consideration very well at this point in time. So looking at the consideration, I said which exceed the net asset, fair value of the net asset acquired, then you have goodwill. So what is that consideration? Consideration is the payment that you made. Consideration can be in the form of issuing additional shares. Consideration can be contingent consideration, can be something that will occur in a period of time. There's a way we do that. So if you want to know how to the type of different consideration, I strongly suggest that you also watch my video on consolidated financial statement, because for the purpose of this IFRS 3 business combination, we're only talking about the process here. We are not talking about how we consolidate it, so I won't be going deep into it. Also, there is a fair value of non-controlling interest, because when you acquire an entity, you don't acquire, let's say you don't acquire 100%, you only acquired 80%. There is a fair value of the non-controlling interest that we made mention of the last slide. So we need to add it to the consideration. Plus, there could have been at a point in time when you do acquisition on a stepwise basis. Let's say, for instance, you acquire less than 20% in an entity. When you acquire less than 20% in an entity, it means you acquire interest which will be accounted for under IFRS 9 financial instruments, equity instruments. So that's one. You could have acquired the entity more than 20% but less than 50%. So if it's more than 20%, it means, and less than 50%, it means that's an associate who could have been will have accounted for it under what we call equity method under IS 28 investment in associates. So when you do this acquisition stepwise, you have accounted for something under financial instrument or under equity method. What the standard says that we now need to remeasure this equity instrument by the time you now attain control. You attain control at 51% above. So when you now attain control at that point in time, the previously earned interest that you had in the in the entity before, we'll do fair valuation of that interest and we'll add it to the consideration. So fair value of the non-controlling interest, fair value of the prevailing interest, plus the actual purchase consideration will now take a difference between it and that of the fair value of the net asset of the subsidiary that was acquired. So when you have a positive figure, that is the fair value of purchase consideration plus all this in excess of the fair value of the asset acquired, we have a goodwill. But there could also be an instance where this fair value of the net asset acquired could be more than the purchase consideration. That means we have a negative goodwill. So we call it gain on bargain purchase. So what that means is that, for instance, you know an entity worth maybe $10 million, but you now pay $9 million for that entity. It means you bargain very well. So it means that $1 million is the gain on bargain purchase. This is not always the case. Most of the time we have goodwill on acquisition. So but when you have a bargain purchase, the treatment is different. A goodwill is expected to be recognized as an intangible asset in non-current asset. So you see it as an intangible asset, and what you do to goodwill is that you don't amortize goodwill. Under IFRS you don't amortize goodwill, but under financial reporting standard 102, I think you amortize goodwill over a period of time, useful life, which should not exceed 10 years. So that's the difference between IFRS and FRS 102. So but under IFRS 10 or an IFRS 3 business combination, you test for impairment, annual impairment review for the goodwill. So I did another video separately for, I think, under IAS 36 impairment of assets, which I talked about goodwill impairment in great detail. So if you need to watch those videos to understand how we test for impairment of goodwill. So the standard IFRS says that we do annual impairment review on goodwill. If there's any impairment in goodwill, then we impair the goodwill. But if it's a bargain purchase, gain on bargain purchase, like I mentioned earlier on, that is the fair value of the net asset of the subsidiary that was acquired is more than the purchase consideration, then it means we have like excess, which is a negative thing, like a profit. So that profit will go to the profit and loss account. We don't put it as a liability. It's a profit on, like a gain on bargain purchase, which will go to the profit and loss statement. It should not stay in the balance sheet. So that is IFRS 3 business combination in summary. So I would strongly suggest that you watch my video on IFRS 10 consolidated financial statement for people to understand how we prepare a group account. Thank you and God bless you.